stressed asset with no stress, the previous speaker said. So I think it's good fun. I think I can tell you that Indian Hotels, we have decided that we will not bid for stressed asset because it's just not worth the effort actually. On that, I can speak later separately. Anyway, I think coming to the subject of ethics actually, I think it is a very important topic, and very often you hear headlines in terms of different, frauds and misreporting. You keep hearing it with some unbelievable frequency actually. And therefore I think it's really important that, that as CFOs we play the role that we are supposed to play. Because I think what matters, I think a lot of us focus on business performance, and I think what we do matters for sure actually. But how we do matters even more actually. I think what I'm really going to be talking about today is how we do matters actually. And there is really no, commercial success is not the end all. Ultimately, I think if it is not done in a fashion which is kind of appropriate. So hence I think what can CFOs do? A lot of it, of course, begins with the tone of the top. And I can tell you, many of us think that when you say tone of the top, it's really the board, it's really the CEO who sets the tone of the top. But as CFOs, I think we are also at the top actually. So the tone of the top actually starts with us. And many times I think the advantage we have in our roles is that we can be what I call as connected to the business, but at the same time be objective in terms of what we do. And therefore, we are in many senses in a unique position to be able to look at performance holistically and be able to advise the business on it actually. And I think, and when you look at the genesis of why some of these things happen, I think it usually starts with the business plan. Usually it starts with the business plan. The question about business plans is that, is it an aspirational business plan that you're setting? Because now this is the month of May, June. You guys must have just completed the budgets for the year. You're probably at your first quarter in terms of performance. So when you did your business plan, got it approved in the month of March, what kind of a business plan did you set? I think if the business plan is very aspirational, and many companies do it, because philosophically some companies say that an aspirational business plan is great because it allows us to kind of achieve what we want to do better, and it rallies the organization. Perfectly fine actually, perfectly fine. And there is nothing wrong with an aspirational business plan. Personally, I also like an aspirational business plan actually. But the problem is when aspirational business plans are set, it must also be matched with what I call as a risk matrix, a simple risk matrix, which says that here is a business plan which is aspirational. We think it's got a stretch, which we got a stretch of 25, 30, 40% as an example actually. But be aware of the stretch in terms of the risk to that business plan actually, which is really top line, bottom line, balance sheets and all of that. And be clear about what risks you're taking actually, what risks are inherent in the business plan. And the reason I say so is that most of the genesis in terms of misreporting, frauds and all happen because the risk management has not happened correctly actually. Because once you understand the risks, then you know whether you are setting yourself up for success or failure. And then it's a question of reporting accordingly. And therefore, I think one of the things I always like to do in business performance discussion is really to talk about the risks facing the business and what are we doing in terms of resolving those risks actually. That's a very healthy discussion as opposed to setting up an aspirational business plan without an adequate risk management. Most of the times, I think when frauds happen, when misreporting happens, when communication failures happen, it happens because people are afraid to talk about the performance of the business. It is because they have not done their risk management properly actually. I think it starts with that. And therefore, the role of a CFO in terms of articulating and making sure that a risk plan is there alongside the business plan is a starting point of ensuring that the organization is on the right track actually. And in fact, I think there's a great example, Ian Fitzgerald was one of the CEOs of Unilever, and he retired in 2008, 2009 before Paul Polman came in. He was given charge, when he was not a CEO, chairman of Unilever, he was the marketing head, and he was given charge of launching Persil in Europe actually. And he was taking on P&G. The company made $700 million of losses. Normally for somebody with losing $700 million of losses, he would have lost his job actually. But he went on to become the CEO of the company actually. Why? Because risk management played a role. And the reason I stress on risk management again for the last time before I move on to other things is to make sure that people understand the risk even before you're starting out. Many times what happens is, and when you say people understand the risk, it's also about making sure the last line, the last level in the field also understands. Many times what happens is targets are top down actually. When targets are top down and the guy in the field says, hey, these targets are unachievable actually, that's where the bad practices start to happen actually. Hence, I would certainly say that from a CFO's position, in terms of making sure that the organization, beyond the values and whatever it says, organizations like, for instance, the Tatas, where I belong, the purpose, the ethics is kind of completely implicit in everything we do actually. But every organization is not like that. There may be statements in terms of purpose and ethics actually, but but it may not translate itself down the line. And when you have a target which is unsustainable, that is where the things start to fall apart actually. Hence, I think as CFOs, I always say that you please make sure that you start with the business plan and make sure it is sized right actually. So that's number one. Number two is that I think we have seen a lot of challenges in terms of business plan sustainability in startups. And I think startups, we have seen a number of different challenges. And part of the reason those things have happened is because funding was available. Until about 2 years ago, interest cost on funding was near zero. Even private equity funds were heavily leveraged actually, because leverage allowed them to maximize their return on capital. And therefore, people got money. You take a company, delivery company, what is that, like Swiggy and even the other counterparts. Many of them were making losses on every order they delivered actually. Every order they delivered. So how the hell, gross margin is kind of negative. How do you have a sustainable, business plan? And I think startups have been one of the causes. And when you see the recent spate of IPOs, which happened in the last couple of years, I don't know whether many of you realize that 65% of the IPOs since 2022, the IPOs were fashioned around secondaries, which means existing investors sold out actually. And so money did not go into the company. Money was used to pay out the existing shareholders and private equity funds and other early investors actually, which means they cashed out at extremely high valuations. And you know the story of Paytm and others, where 2,400 rupees of IPO price crashing subsequently to 600. It's a public example. I'm not passing any judgment on Paytm or something like that. But I'm just saying that startups have unfortunately seen waves of challenges in terms of ethics actually. You know what's happened to Byju's, $22 billion market cap, now probably worth nothing, to be honest actually. These are all examples where ethically kind of things go awry, to be honest actually. And as CFOs in these companies, I think it's very important to make sure that the tone at the top that you set is very, very clear actually. The third thing is that I work for a listed company, and I think a market cap touched $10 billion. And I think one of the biggest things that investors look for in CFOs is very, very, very transparent communication actually. Very transparent communication. In my company, for instance, I have the Tata promoters. Tata Group itself as a promoter at around 40%. I have 40% of institutional shareholders, 20% of domestic and about 20% of international investors, and I have 20% of retail investors actually. I can tell you that in every investor meeting, I think the only thing I'm conscious of is that am I authentically communicating actually. It's very, very important, because many times what happens with investor communications is that we're all happy when things are going well, to say of course we have done very well and do a lot of rah-rah. But when business starts to go down, are we also communicating authentically actually? Because bear in mind that one of the things I've always seen in my experience is that investors understand that companies will go through ups and downs actually. And as a CFO and as companies, I'm always looking for long-only investors, which means I'm not looking for hedge funds in my cap table who are there for maybe 6 months, 1 year, and who kind of sell out, to be honest actually. I'm looking for the big investors who stay with me for years actually. And these investors also understand that companies can go up and down, but they will stay put as part of the portfolio, because it's also not their job to churn portfolios unnecessarily, to be honest actually. And though they understand that companies can go through times when things are not so good actually. And how can you be authentic in terms of that communication becomes really important actually. And if you explain to them, because ultimately it all comes down to the business models, if you explain to them that these are the factors which are changing, and therefore your performance is likely to be lower than what you thought it will be, or from prior communications or from prior years, and it is done systematically and also communicated in terms of authentically in terms of steps you're taking in terms of recoveries, I think investors will stay. But 1 quarter, 2 quarters, you say something, and the results that you communicate at the end of the quarter is not in line with what you have communicated actually, you will find that investors kind of go away, to be honest actually. Because money is fungible. Investors have a choice. And investors ultimately are accountable to their own, retail investors and others who put money into the funds, to be honest actually. Hence, I think authentic communication will allow you to make sure that people are staying back on your cap table, to be honest actually, and nothing is more satisfying than that actually. Nothing is more satisfying than that you have investors who are with you. On my cap table, I have sovereign wealth funds, to be honest. I have leading international investors. I have leading domestic investors actually. Big HNIs are on our portfolio, to be on my cap table actually. And the attempt always is to make sure that people stay. And this keeps changing, See, one of the other things which happens with in terms of investor communication is also in relation to market expectations. See, remember one thing, that when an investor comes into your cap table, he is expecting maybe 15, 20% return, to be honest actually. I can tell you my own case. In the last 6-7 years, we have grown our market cap 10x actually, from $1 billion to $10 billion. There are people who came in at $1 billion. They are either sitting pretty today or they have kind of encashed the money. But there are people coming at the $10 billion market cap also today actually, which means that they are expecting that they will grow returns from here on actually. I think the responsibilities that you have vis-a-vis all the different investors at different points of time become so very critical actually. How do you convince somebody to come in here? Because many times performance again is not short term. See, long term as a short term is one of the biggest challenges in terms of ethics actually. Ultimately, I think we should always emphasize the longer term returns actually. Short-term performance can go up and down, but as long as the long-term trajectory in terms of what the company is setting out to do, in terms of the strategies and execution are made clear, then people will stay through the long term, to be honest. So communication becomes extremely critical in terms of making sure that authentic communication, to make sure that people stay on, to be honest, actually. And ultimately, I think what is very important is how do you build a culture within the company actually. I think there CFOs have a very big role actually, very, very big role. I think today the regulators are kind of relentless. Internal cultures are also relentless actually. Reputation is very critical, guys. Ultimately, if you're a CFO of a company where you have had to explain a fraud outside actually, or a misreporting outside, your reputation is finished. What do we have? We are not born. I wish I was born with some $100 million when I was born actually. I was not. Ultimately, we've all built our careers actually. It needs one incident to tarnish your reputation, to be honest actually. Hence, I think how do you build the culture becomes important actually. That is where I think I relentlessly play the role in the company in terms of enforcing ethics actually. In fact, sometimes more than people would like. Sometimes we have to be quite tough in terms of making sure that, things are, where things are not going right actually. And one important test that I do follow is what I call as a smell test. Does anybody know what a smell test is actually? A smell test, and there was a recent example where the smell test failed actually. A smell test is something which looks absolutely fine on paper, but it doesn't feel right, to be honest. Linde India, recently Linde India was in the papers, as you know. Linde India, if you know what happened, was that Linde India is a listed company, and the Linde India also has a 100% subsidiary actually. And when they acquired Praxair, businesses were reorganized, and the argument was that the minority shareholders in Linde India, which is a listed company, suffered because the businesses were reorganized between the listed subsidiary and the unlisted 100% subsidiary in a way which favored the unlisted subsidiary actually. And the directors, independent directors in the company, took a stand that they had taken legal opinions actually. So legal opinions from the best of lawyers were taken, saying that what the company was doing was right. And yet SEBI came with an order and said that, sorry, those legal opinions are invalid actually. Ultimately, you have probably acted in a fashion which has been detrimental to the minority shareholders in the company actually. And therefore, I think resorting to legal opinions is not necessarily good ethics actually. Where it doesn't smell right, please don't do it actually. And the smell test is a very difficult thing. Many times, we're all looking for legal opinion to back up what we're trying to do actually. But it's not always a good thing that legal opinions cannot back you up. Because ultimately when SEBI says it's not right, it's not right. And minority shareholders of Linde India, which is a listed company, can rightfully say, sorry, I think you have organized your business to benefit the the parent company is 100% subsidiary actually. So I think this is, the reason this is becoming important is that it is not the letter of the law, the letter of the regulation. It is now coming to the spirit of the regulation actually. Exactly, exactly. Ultimately, absolutely. So that's why the smell test becomes extremely critical actually. And hence I think CFOs have a role to play to sort of say that if it doesn't sound right, you have an obligation to sort of stand up and say, sorry, this is not something that we should be doing actually. And it's not easy. See, ultimately building a culture, and when you say building a culture, it has to go right down to every level in the organization, to be honest actually. And you have to play that role in terms of being the active communicator actually. And that's not easy. Many times, people, you may be accused of saying, "Aa gaya banda," to who has come and saying that, "Hey, nahi karna chahiye," actually. Of course, we are all here for enabling business, but we are not here for not enabling business actually. But ultimately, we have to think of the long term and what is right. And I know there are enough studies to say that McKinsey has done studies which say that companies which are ethical have an incremental market cap premiums which come because of their ethical. Look at Tata Group actually. The market cap of the company, of the total market cap of companies is, I do not know, I don't even know the number. It has grown actually. Governments work with us in terms of giving projects with the full safety that, we will do things ethically, to be honest actually. So being ethical brings real business advantages actually. Brings real business advantages because nobody wants controversies, even governments, to be honest actually. Hence, I think I cannot understate the importance of ethics. I used to work for Merck earlier, and Merck is a blue-blooded $200 billion market cap company in the US, to be honest actually. We have shut down countries because of compliance actually, because of compliance. It didn't matter whether the country was generating $100, $200 million of profits, but if it is not compliant, we would shut it down actually. And of course, it comes from a very US context where SEC can be very significant. In fact, this is one thing, if you're working for multinationals, be aware that, and even Indian companies, many Indian companies behave like Indian companies, but they're all operating internationally. And when you're operating internationally, I think you are bound by those regulations. SEC is unforgiving. If you're a US company, and if your Chinese employee has bribed somebody, the board of directors of the US company are obligated. They cannot say that I'm not aware that my Chinese employee has kind of bribed the doctor, to be honest actually. And the fines are huge. In fact, I remember in Merck, my legal guy had a statement on his room. Compliance is expensive, because that is one refrain which used to come. But he would say, try non-compliance actually. So I think the point is that compliance can be expensive, but non-compliance is even more expensive beyond reputations, to be honest actually. And I think it's so important. Like I remember, there was this big scandal in China, in one of the multinational pharma companies, I won't mention the name, where I think doctors were being bribed actually. And Merck, and they were using travel agents and all of that actually. And Merck was using the travel agent earlier. The regulators asked Merck as to what they did. The reality was that our own internal audit and internal investigations had pointed out to bad practices, and we had actually got the travel agent out actually. So which means that I think there is merit in terms of making sure that compliance, ethics is kind of not compromised at all actually. I mean, this is a subject which we can talk completely, but the point I'm saying is that I think there is no compromise on ethics, guys, actually. Anything that is done which is compromising ethics actually cannot be sustainable, it cannot be long-term actually. And as professionals, where our reputations are at stake actually, unless, I think it's so important that we kind of make sure that we play the role of ambassadors in upholding a culture of ethics, is what I would say. Happy to take any questions. I mean, I'm almost out of time, but happy to take any questions. Yeah. Yes, of course. Yeah. Yeah, I think promoters' expectation. I know it's not easy. If you're working for
so generally promoters will expect some sort of levy being taken.
Yeah.
In possibly being slightly, I'll not use the word unethical, but it could be slightly giving away, or maybe not saying something which you normally would see.
I can tell you one thing.
Difficult to balance.
Promoters like to take risks. Promoters don't like the consequences of the risks actually. I think as long as you keep putting the consequences of risk in front of the promoters, I've done it in one of the companies that I worked for a promoter. I kept going to him whenever I felt uncomfortable. And ultimately I left that organization, even though that is a company where we took up market cap 18 times actually. But ultimately I think you will have to keep at it actually. Ultimately the independence of the CFO is very critical actually. Don't forget that, guys. Don't forget that.
I know.
Because ultimately, if it is a 100% promoter-held company, that's a different thing. Then it's your own private company. You do what you want actually. And ultimately, externally, the law will take its course. And there again, you don't want to be in a situation where you want to get stuck with the law. But if it is a listed company, and you are the spokesperson, and remember, CFOs are spokespersons actually. And hence, I think even in promoter companies, I think you have no choice but to play that role actually. And I think to many extent, when you point out the risks of non-compliance, and maybe you can be creative, in terms of finding other solutions actually, which are within the boundaries of the law, and kind of say, you can achieve the same business outcomes, maybe doing things better, or tell him that maybe the cost of doing it is maybe another 10%, but then it's a cleaner solution. I think that you can certainly do in terms of emphasizing the importance of it. And today, I think I can tell you, promoters, while you see frauds and all coming up actually, nobody wants to be in trouble. Nobody wants to be in trouble actually.
Yeah, thank you.
Yeah.
Any more questions? All right, so let's move ahead. Sir, I would request you to stay back on the stage, and at the same time, I would request Mr. Nishant Vyas, General Manager, India Walters Kluwer, to felicitate Mr. Giridhar.